The market just handed us a masterclass in human psychology disguised as a year-end rally. While everyone celebrates the S&P 500's 18% gain and fresh all-time highs, I'm watching something far more revealing: the simultaneous surge in gold to record levels and silver's staggering 155% climb. When investors bid up both risk assets and safe havens to historic peaks in the same week, they're not showing confidence, they're showing confusion. This is exploitable because confused markets create the most predictable patterns of all. Here's what's actually happening beneath the surface celebration. The GDP number that just dropped at 4.3%, crushing the 3.2% consensus, should have been pure rocket fuel for stocks. Instead, we're seeing defensive rotation into precious metals and crypto outflows exceeding $600 million in a single week. The crowd is celebrating with one hand while hedging with the other. Classic late cycle behavior. Today I'm going to show you exactly how human psychology is creating three distinct exploitable patterns in this market, why the system's response reveals the true risk-reward structure, and the disciplined approach that positions us for what comes next. Let's start with the human layer, because understanding crowd psychology is always our edge. The market participants right now are trapped in what I call the success paradox. They've ridden an 18% rally in the S&P 500. But that very success is creating the conditions that threaten it. Think about the psychology here. When GDP growth jumps to 4.3%, well above expectations, it validates their risk-taking, but it also reduces the probability of rate cuts that enabled their gains in the first place. Good news becomes bad news. The cognitive dissonance is palpable. This shows up in three predictable ways. First, recency bias from consecutive record highs. Participants expect the pattern to continue simply because it has continued. Second, loss aversion triggered by thin holiday liquidity. Every small move feels amplified when volume disappears. Third, narrative exhaustion around AI dominance. Even the most compelling story eventually needs new fuel. Watch the rotation from mega-cap technology into financials. This isn't strategic rebalancing, it's psychological fatigue. When the market has to work harder to find returns, spreading capital across more names instead of compounding it in fewer winners, that signals diminishing marginal returns to the prevailing strategy. The Russell 2000's underperformance while large caps hit records confirms this. Risk appetite isn't expanding, it's redistributing within the same pool of capital. Now here's where it gets interesting. The precious metals surge, gold hitting its 54th record close of 2025, silver at $76 per ounce. This isn't fundamental revaluation, it's reflexive fear masquerading as opportunity. When participants simultaneously bid up the S&P 500 and precious metals to historic levels, they're hedging against uncertainty they can't even articulate. Pure emotional hedging. The crypto market tells the same story. Bitcoin range-bound between $86,500 and $90,000 for weeks now. That's not consolidation, that's decision paralysis. Neither bulls nor bears have conviction to break the equilibrium. The $175 million in Bitcoin ETF outflows and $52 million in Ethereum outflows show institutional participants are reducing exposure, not adding. Surface calm, hiding underlying withdrawal. This brings us to the system layer, how these psychological patterns create exploitable market structures. The system responded to that GDP surprise with surgical precision. Growth at 4.3% immediately compressed rate cut probabilities for early 2026 from multiple cuts to a coin flip on March action. The 10-year Treasury tested 4.19% before settling near 4.13%. The 2-year yield declined to 3.48%. That flattening spread tells you everything. The bond market is saying the Fed has more time to wait. Higher discount rates for equity valuations. But here's the disconnect. Equity indices posted their fourth consecutive weekly gain despite hawkish macro data. The Nasdaq's 22% year-to-date performance versus the Dow's 14.5% reflects AI capital expenditure dominance, but even Tesla and Nvidia retreated in pre-market trading. When the Magnificent Seven show vulnerability, that's a system-level signal. Commodities exhibited what I call bifurcated behavior. Precious metals surging while crude oil declined 2.8%. This reveals a market pricing monetary debasement fears rather than growth optimism. Silver's 155% gain in a year. That's not a fundamental revaluation. That's reflexive response to perceived fiat currency erosion. The faster the ascent, the more violent the eventual correction. The technical structure shows compression across asset classes, the S&P 500 trading just 1% below 7,000 while volume remains below 30-day averages, creates a coiled spring dynamic. The VIX at 13.60 reflects complacency, yet precious metals surge contradicts this sanguine volatility pricing. When implied volatility in equities diverges from realized volatility in commodities, that structural tension will resolve dramatically. The crypto system remains in what I call exhausted equilibrium. Bitcoin's failure to sustain breaks above $90,000 on 3 separate attempts reveals overhead supply at that psychological level. On-chain data shows short-term holder cost basis at $99,900, while spot trades near $87,800. Recent buyers are underwater by 12%. That creates resistance as price approaches break-even zones. Ethereum's decline below $3,000 signals relative weakness, which typically precedes broader crypto stress. This is a system exhibiting classic late-cycle dynamics: valuation expansion without corresponding earnings acceleration, rotation from momentum to value, defensive positioning in alternatives, compressed volatility despite elevated uncertainty. These don't predict timing, but they define risk-reward asymmetry clearly. Now for the Stoic approach, the disciplined response that exploits these patterns. The market is not priced for reality. It's priced for the expectation that others will continue pricing the same narratives that worked for 11 months. When everyone is hedging, the edge belongs to those who can wait without acting. This is not a market with conviction. This is a market hedging all outcomes. The GDP print at 4.3% exposes the fragility of current equity valuations. If growth remains robust, the Fed has no reason to ease aggressively, removing the liquidity tailwind that propelled multiples to current levels. If growth decelerates, earnings estimates compress. The market is priced for a Goldilocks scenario that requires threading a needle between these outcomes. Such narrow paths rarely persist. Holiday-thinned liquidity creates an environment where price discovery is impaired. Moves in this regime carry less information because they reflect actions of a non-representative sample of participants. The Stoic approach doesn't trade noise. We wait for volume to return and for the full participant base to reveal their collective assessment. The Santa Claus rally narrative is a cognitive crutch, a pattern that provides comfort but no edge. Historical averages aren't predictive when underlying conditions have changed. The system is extended, fragmented, and operating in a liquidity vacuum. These conditions favor range-bound trading with sharp intraday moves that reverse. Here's the disciplined positioning. In environments where the cost of being wrong exceeds the benefit of being right, capital preservation becomes the primary objective. Patience becomes the primary tool. We maintain flexibility, reduce leverage, and focus on asymmetric opportunities where potential gain exceeds potential loss by meaningful margins. The week ahead features FOMC minutes on December 31st. If they reveal dissent about inflation persistence, markets reprice hawkishly. If they show consensus around data-dependent pause, markets interpret dovishly. We observe these data points without attachment, knowing each release is a single frame in a longer film. Geopolitical backdrop with China's Taiwan drills and stalled Ukraine peace talks adds tail risk not priced into current volatility levels. Markets have become desensitized to geopolitical headlines, creating vulnerability to actual escalation. We maintain awareness without overweighting. Understanding low-probability, high-impact events are difficult to hedge efficiently. The final assessment: this market is exhibiting signs that favor the patient over the aggressive, the systematic over the emotional. When precious metals and equities simultaneously hit records while crypto bleeds capital and bonds price in policy uncertainty, that's not strength. That's fragmentation of consensus. The path of least resistance is sideways until a catalyst forces resolution. We don't predict which direction that resolution takes. We position for either outcome by maintaining discipline when others are hedging their hedges. If you value systematic thinking over market noise, hit that like button and subscribe for more objective analysis that cuts through the emotional static. The link in the description contains our complete framework for exploiting predictable human behavior in markets. Because while others react to what's happening, we profit from understanding why it's happening.